Good morning. My name is Lynn Gillette. I'm the president of the Silicon Valley chapter of AAII, and I'm welcoming you to our income investing presentation. Okay, our first speaker is Harry Domash. He's spoken to us before. He's publisher of Dividend Detective Inc. and the Winning Investment Inc. His presentation is titled Preferred Stocks, a relatively low-risk way to earn 4 to 7% annually. And he'll be dealing with such topics as how to maximize preferred stock returns, how to minimize risk of preferred stocks, and issues about preferred stocks, the tax issues that are involved there. Harry publishes, as I said, Dividend Detective and the Winning Investing and .com. The second one, winninginvesting.com, is a free publication which features investment tutorials and other resources focusing on helping you to be a better investor. Full disclosure, I subscribe to the Dividend Detective Inc. and use it as a quick source of what's going on in the whole income investing area. Harry is a seasoned analyst. He has published, he's published in the San Francisco Chronicle and on a number of investment websites such as Seeking Alpha and MSN Money. His best-selling stock analysis book, quote, Fire Your Stock Analyst, Analyzing Stocks on Your Own, is very popular and has been translated in many languages, including Chinese and Japanese. And we will start our presentation right now by turning the time over to Harry, and you have until 10:15 or so, and then we'll have a short break and then go to our second speaker. So you have the podium, Harry.
Thank you, Lynn. Welcome to my presentation. Basically, I publish Dividend Detective, as Lynn mentioned, covers all kinds of different dividend-paying stocks and things like that. But when someone asks me what's the best way to just invest for income, I always refer them to preferred stocks because it's the stock market, so there's risk, of course, but I find that preferred stocks are the best way to produce an income stream with lower volatility than the overall market. So let me just figure out how to move the slides. So here's why there are preferreds. Corporations sell preferreds to raise cash. In effect, preferreds are bonds that trade like stocks. So if you buy preferreds, let's just say that Google issued preferreds. I don't do, but have to do. And Google share price doubles or triples or something. Your preferreds you're not going to make that much money on the preferreds. Preferreds are more for income with some appreciation potential. And I'll show you what our history is for preferreds. This is the Dividend Detective preferred stock portfolio, which has between 25 and 30 preferreds in it all the time. Right now, I think it has 30, and 29 of them are buy rated at this time. And this is what see the returns have been per year. These numbers assume that you bought whatever stocks we added to the portfolio and sold them when we told you to sell them. And so you can see that generally preferred stocks underperform the S&P 500, but they're less volatile. Any questions or anything on what we said so far? go on to what's preferred about preferred stocks. Basically, the main difference of preferreds over common stocks is corporations must pay their preferred dividends before they pay their common stock dividends. That's about it.
Harry,
Yeah.
very quick question. So back to your slide 3, the performance numbers you give, are those without the dividend payouts, the returns?
The returns are capital appreciation plus dividends received.
Oh, it does include dividends received. Thank you.
Okay. So here are some what I call meaningless distinctions. Preferreds have priority in a bankruptcy, but usually in bankruptcy, common holders and preferred holders don't get anything. So it doesn't matter. The other thing is preferred holders can't vote. How many times have you voted in a election? Usually most single individual shareholders don't vote. So that's kind of the preferred thing about preferred, that they get the dividends. If a company runs short of cash to pay dividends, they get the dividends. Preferreds do before the common stock dividends can be paid. So the most complicated thing about preferred stocks are the ticker symbols. The symbols are not standardized. So whatever website you go to might have totally different ticker symbols, but usually there is something common about them. You start with the common stock symbol, like I use Bank of America, BAC, as an example, and 90% of preferred ticker symbols start with the common stock. Sometimes they don't. So corporations usually issue a series of different preferreds, A, B, C, D. Some of them are up to N and P and stuff. So the ticker symbol usually starts with the common stock ticker and then add something to it. So if it's series N, on certain websites, it'll be BAC-N, and other websites, BAC-PN, or it could be PRN or anything like that. But it does have the ticker, it does have the series on it usually. So what you do, if you go to a website, is you use the lookup function on the website, and you start with the common ticker, like in this example, BAC, and usually the website will then display all the preferreds. And so you can figure out from that which one you're looking for. And once you've done it a couple of times on a website, you kind of get the hang of it, and you'll be able to figure probably what the ticker symbol is going to be on that particular website for any preferred. I listed at the bottom the sites. For example, I use BAC-N, the simplest way, and Google Finance, Quantum Online, TD Ameritrade, and Dividend Detective all use that format. They're the only ones I know that do use that format. So that's the trickiest part of preferreds is the ticker symbols. So preferreds, just go over kind of what they're about. Preferreds can be issued at any price. I would say 90% of them are issued at $25, but some are 10 and some are 50, some are 100. They may or may not, preferreds may or may not have a maturity date, redemption date. The coupon rate, if a preferred is like a 5% preferred, that means that's the annual dividend divided by the issue price. So if it's the coupon rate assumes that that's the dividend yield if it stays at the issue price. Now, usually what happens is preferreds, I hear a pounding, I don't know where that is. Usually preferreds start trading at around $23, $24, and then they move up to 25. After about a month or so, they're usually trading at 26, 27, and sometimes they trade up to $28, $29 a share. So your actual yield that you'll be receiving is depending on what the market price is at any time. Now, preferreds can be cumulative or non-cumulative. Cumulative means that the issuer remains on the hook for any missed dividends. That sounds good, but it's not a huge advantage because if a company runs out of cash to pay their dividends and they stop paying it, preferreds are going to go down in value pretty quickly, even if they are cumulative. Now, the one thing about preferreds that you need to be aware of is preferreds can be called. Most preferred calling means the issuer redeems the preferreds at the call price, which is typically the issue price. So $25 preferred can be redeemed at $25, can be called at $25. Typically, the call date is 5 years after the IPO, but it can be, that's the earliest date they can call them, but companies, the issuers don't have to exercise the call to call. Sometimes they never call them. So the call date is kind of a worst case situation because that's the date it can be called at 25, but they won't necessarily be called. Usually, issuer calls preferreds when it wants to issue new preferreds at a lower interest rate. So if interest rates are lower, then when it issues the preferreds, it's likely to call them and issue new preferreds at the new lower rates. The important number you need to know is yield to call, which is the average annual return you receive if the preferred were called on the call date. That's a worst case scenario because preferreds typically are not called exactly on the call date. Even they might be called a month or two after, or they might, as I said, they might not be called for years afterwards. So that's basically the calling is what controls everything in terms of how much money you make on preferreds, depending on when they're called. So to optimize preferred returns, you need to buy them close to the time they're first issued. When preferreds are issued, they typically trade right now in this market, they're trading between 25 and 26, although lately they've some of them trading around 24. But until January, say last year, most preferreds, as soon as they were issued, moved up into the 25, 25.50 range. And then after a while, they move up to 27 plus. And then it's kind of too late to buy them, you know, if you really want to get a good return on them. So you need to buy them soon after they're issued. A lot of preferreds trade up to $28. Some trade as high as 29 or 30. When they get up to that range, we usually recommend selling them because they're going to move back down eventually. And after the call date, now preferreds don't, as I said, preferreds don't have to be called at the call date, but after the call date, they usually trade in the $26 range. So if you've got a preferred that's trading at 28 or 29, then you ought to sell it at least 6 months before the call date, because it's going to go down to $25, $26 after the call date, even if it's not called. Now, what we do is we use yield to call to determine when to sell or buy a preferred. Basically, yield to call is the average and is the annual return you would achieve if preferred were called on the call date. I mentioned that already. And the call date, if it's a year or so ahead, we would buy anything with yield to call of 10 or anything that would be a buy signal. Now these vary depending on whether they're rated by a year by S&P or not. But if they're rated by S&P, we usually use lower yield calls, and if they're not rated, we use higher yield calls. If the call date is less than a year ahead, we sell when the yield call is less than 2%. And then if you want to calculate the yield to call, I'll give you the website where you can put in the numbers and get the yield to call for any preferred. So the risks of owning preferred stocks are if their dividends are canceled or suspended. That's the major risk of owning a preferred stock. And so the other risk, a main risk, is rising interest rates. Right now, interest rates are low historically, even though people are excited about them hitting 2%. But if, let's say, you could get 4% from a money market account, you probably wouldn't be as interested in buying preferreds as you are now when you get almost nothing from your money market accounts. So preferreds will go down in value if interest rates should go up to like 3, 4, 5%, stuff like that. Right now, it doesn't seem likely, but nobody can predict that really. Low trading volumes is another preferreds. We recommend that you stick with preferreds that have a 10,000 share trading volume per day, and higher is better. Any questions so far or no? Not hearing anything. So when you're buying preferreds, the number one priority is analyzing the issuer. In fact, that's the whole story with preferreds. So as a quick check, before you do anything else, you look at a preferred and you look at the issuer's share price. And if the prices of the issuer's shares are trading for under $5, like $3 or $4, I would stop right there. That is a risky. It's a risky company. So I wouldn't go any further. You don't need to get out your green eye shades. If it's a cheap issuer is trading under $5. Other than that, what you have to do is look at free cash flow that the issuing company generates. Free cash flows is the cash that's left over after a company has paid its operating expenses and capital expenditures. So I would recommend that you always require positive free cash flow from the issuer of any preferred you buy. And the other issue of free cash flow is a cash after paying operating expenses and capital expenditures, but it doesn't include taking into account common stock dividends paid out. So there's another number you can look at that that tells you how much is paid out in common stocks. Here's how you can use Yahoo. Here's how you can use Yahoo to find the cash flow. You go to Yahoo, look up the issuer, and you look up financials, and then click on cash flow. And you can see free cash flow right there. You always want that number to be positive. Now, let me diverge a minute, change the subject to common stocks, okay? If you're buying, if you want to buy dividend-paying common stocks that are going to beat the market, you always want to start with a company that meets this requirement, positive free cash flow. That's the most important number you can look at when analyzing a stock, especially a dividend-paying stock. So now if you're on Yahoo and you click on cash flow, you see this. If you click on expanded, then you're going to see the cash dividends paid. Now you, obviously you would want what's left after you've paid the cash dividends to be a positive number too, but I haven't really researched that enough to know how much difference that makes. But I think it's obviously desirable that you want the total cash free cash flow minus the dividends paid to still be a positive number.
Yeah, one question, Harry, is I understand that with preferred stocks, if they should cease paying dividends for a year and then start again, they're obliged to pay the dividend that was missed plus new dividends. Is that correct?
It's only correct if you're cumulative. Cumulative preferreds, about half of those issued are cumulative, require them to pick up any missed dividends. Non-cumulative, they're not required to pay missed dividends. So that's a good thing. It sounds like a good thing, but you really don't want to get in a position where that comes into play, because by the time you've got a preferred that's missed its dividends for a year, you've lost your preferred share price has probably gone down to $10 from 25, So it's really, while that's significant that it's cumulative, it's really more important to make sure that the preferred issuer is not going to run out of cash. If you own a preferred that, and all of a sudden, even though you qualified the issuer when you first bought it, now something's happened that you might as well sell your preferreds as soon as you figure that out, because if they skip the dividends, the preferred is not going to be very profitable for you. So the tax issues with preferreds, you can have qualified dividends that are issued by corporations. They're usually up to the maximum 15%, 20% qualified dividend tax rates. But the high-paying company preferreds are usually issued by REITs, BDCs, business development corporations, and we have one delivered by Farm Cooperative. And also preferreds that are called baby bonds, where the payments are classified as interest, not dividends. they don't qualify for the cheap rates either. So we have a lot of REIT preferreds that we recommend, and also BDC preferreds in one form that we recommend, because their yields are higher, you know, and so it's a trade-off. You know, you get the higher yields, but then there's the tax issues.
Harry, I got a couple of questions. One is, how do you get notification of the issuance of a new preferred?
How do you what?
How do you get notification, or how do you learn about a new issue of preferred stock? Where do you look?
Quantum Online is the place to go for preferred stock information. It's a free site, but they do ask for donations to support them. But they have all the information about existing preferreds. You put in any ticker symbol of existing preferred, you get all the information on it. But then also they have a screener. If you go look under income tables, I don't know if you can see the cursor on here or not. Look on income tables. Then there's a screener, and you can look for recent IPOs, and that's what I do. That's how I find them. So Quantum Online is the place to go for deferred stocks, new issues, or just for information on preferreds. It's the main source of information on preferreds if you're going to do it yourself. Now here is preferred ideas. These are this is some preferreds that we're recommending right now. I think we're recommending 29 preferreds right now. We have one that's not a 30th that's not buy rated right now, but this is the what we look at, and these are preferreds that I'm telling you that I'm recommending you buy right now. Like I said, we have about 29 buy rated, but I picked out ones that I thought would be of most interest to display here. And this is the information we display on our webpage for our preferred. This is the kind of information we give on the preferred portfolios. So basically, I've covered where to get the information. Since we didn't have any questions, it went a lot faster than I expected it to.
There are a few more questions out here, Harry, that we can go through.
Okay.
First one is about free cash flow. Those negative numbers on the free cash flow details, are they not the deductions from the 60 million or so in FCF?
Well, I didn't understand your question.
Okay, whoever asked that question, do you want to turn off mute and just ask it with a little more detail? Well, let me ask the next question, and then are the number of shares fixed, like a closed or end fund, or increased in response to demand?
Preferreds, they're issued at the IPO. They're generally not changed. Occasionally they do, but 95% of the time, whatever's issued at the IPO is all that's there. Every once in a while, a company will issue more of the same issue preferred. But usually, if they want to issue more preferreds, they just come out with, if they had issue A, they would go to Series B and issue new preferreds. So say usually companies issue new preferred. Well, companies issue preferreds to raise cash, so it's whenever they need cash. But lots of times when interest rates go down, the market rates go down, they call their existing preferreds and sell new ones at the lower rates. But generally, it's a fixed amount of preferreds that are out there.
Okay, the next question is, can you go through an example of how to search for a preferred? So I guess someone wants to see your search procedure, or as much as you can talk about that.
Yeah, what I do is I use Quantum Online Screener, and you can issue the screener is pretty good. You can do it by IPO price, or you can do it by well, Quantum Online doesn't know the trading price of the preferred. That's the only problem with it. But you can look for preferreds that are paying a certain interest rate. For most information that you need on preferred, you can get them from Quantum Online. They'll have not the trading prices, but they'll have the call dates and the various parameters. All I can say is that, except for the trading price, you can use Quantum Online to see all the information, which is basically like the S&P ratings, the tax rates, the dividends, dividend. It also shows the pay dates, and it shows you when the ex-dividend are too. So it gives you all. You can look up a preferred on Quantum Online and find out the dividend information and all the stuff we list here. That tax rates and things like that.
Harry, there's a couple questions around, are there any mutual funds or ETFs that basically compiles preferred stocks?
Yes, there are a lot of ETFs that do preferred stocks, and also closed-end funds. Now, I know closed-end funds, a lot of people don't use closed-end funds. They seem to think there's something wrong with them. But closed-end funds like to use leverage to do their investing. And so you can get, what's wrong with borrowing money at 1% if you can get 4% return on it? So a lot of closed-end funds do that. And so you can get higher dividend paying, as a rule, you can get higher dividend paying closed-end funds than ETFs in the same category. But in the and so I use a lot of closed-end funds for that. But there's also in the last year or two, a lot of new actively managed ETFs have appeared on the scene, and they tend to be more like closed-end funds and use leverage and have produced some pretty good returns. If you like to, I can send you a list of them. If you want to send an email to support@dividenddetective.com, I can send you a list of some ETFs that hold preferreds that are pretty good. So yeah, there are plenty of ETFs that do specialize in preferreds, and also, like I say, closed-end funds do the same thing. And for the most part, closed-end funds pay higher dividend yields.
Thank you, Harry. So a question from someone who, if you were to purchase the preferreds individually, is it better to purchase a preferred when it's issued or months later?
Well, I have to wait for Dividend Detective because I have to wait and see what the trading volume is going to be, because I can't recommend preferreds to people that only trade 500 shares a day or something like that. So I have to wait to see that. But I would say sooner is better. Preferreds usually traded their cheapest right after they're issued. And right now, there's quite a few trading, quite a few preferreds. I think I counted 10 last night while you guys were watching TV. I was counting preferreds that were trading under their call price. And I counted about 10 in our portfolios that are trading under $25 under the call price, or, you know, $24.75, stuff like that. And those are the ones you should buy. What I do, I tell our subscribers is to look at the yield to call and pick the highest buy rated preferreds we have with the highest yield to calls, which we list. You can't, it's, if you look over here, this is the yield to call right here, 7.8% for this one. That's high. So yield to call is what I would use. But basically, you get the same effect if you just look at the market price. If it's under $25, that's a good deal. Last year, it was hard to find preferreds under 25 if they've been trading more than a few weeks. Generally, as I said, last year they were going up to 26 within a month or two, and then 27, 28, 29 after that. Now this year, so far, it's been different. So you look for ones that are, the cheaper the better. Just make sure that the issuer has the cash flow to pay the dividends.
Great. And maybe you could talk about ratings a little bit more. The question is, if you're really looking for a fairly secure investment, what importance should an investor give to the security rating of the preferred? And what if it's not rated? Some of your recommendations you showed noted that, you know, they might be speculative, you know, assuming that they were not rated.
Well, that's a good question. You would assume that there's something wrong if they're not rated. In fact, companies have to pay to get their preferreds rated. And so a lot of them just choose not to do it. And I have found in going through, I started my preferreds portfolio in 2008, which is a great time to start it. Everything was going wrong. But what I've learned is that the ratings don't seem to me that accurate. And a lot of investment quality rated preferreds have failed during bad times. So I do my own, you can't see it on here. Well, you can see right here, this is my rating. It goes from 1 through 5, where 1 is best. And most of the ones I rated 3 if they're just sort of ordinary. But I think what I ended up doing by looking at the free cash flow is just as important as anything else. Now, you can use some common sense. If you're looking at a stock, say it's a mortgage REIT, that you know is going to have bad times, then you might deduct. You might avoid it for that reason. If you know about the news, even though it has positive cash flow. But I found that as I said, make sure the stock is trading. If the issuer trading is trading at $50 a share, probably not going to have problems. If it's trading at $3 a share, it probably will have problems. Again, if it has positive free cash flow, I think that's the most important thing you can look at for a stock. As I said, even if you're not talking about preferreds, just for stocks in general, I found that free cash flow really predicts what's going to happen. But anyway, that's what we do. I don't think any of the stocks and all the ones I showed here are not S&P rated. I don't think they're risky, particularly, and so I think we can do a job as S&P and the others can do with it, in my opinion, of course. So that's what I think.
We have a question around if someone wants to buy preferreds in their IRA, is it better to own ETF or the individual preferred stocks?
Well, individual preferred stocks are not buy and hold, okay, because they reach a point when they get close to the call date, say 6 months from the call date or a year from the call date, depending on where they're trading. Let's say you got a stock that's trading for $29, a preferred trading for $29 a share, and it can be called in a year. Well, you know it's going to go down to $25.50 in the next year, even if it's not called. So you want to sell it. So preferreds, we're talking about if you buy them when they're issued, that's 5 years, but still they're not buy and hold. So preferreds required some attention. I think that, well, you could see the returns. Let me go back up to that slide. Preferred, well, what I found, even putting those numbers aside, if I look at when someone buys and sells preferreds that I've recommended, I think they've, on average, the yield, the return, capital appreciation plus dividends return nets out to about 8% a year. And so if you can buy an ETF or a closed-end fund trading for that's yielding 8% a year or better, I would go with it. Or if you don't want to have to deal with selling preferreds when they get closer to call date, if you just want to play golf all day and not worry about that stuff, I would buy an ETF or a closed-end fund. But I think you can get, like I say, about 8% annual returns from the way we do it, but that requires paying attention and looking at our ratings every month. And you know, we come out with an update every month and telling you when to sell them. So if you don't want to do that, then I would use the ETF.
Thank you, Harry. I'm going to call on Al. I don't know, Al, if you could unmute, you might want to ask your question, something around non-callable shares.
Okay, hi. No, I was just wondering, you know, I see some pref shares, they say perpetuity to maturity. Is that the same as a pref share that cannot be called?
No, they can all be called. They almost all have call dates.
They all have call dates. Okay, so that has nothing. So the non-cumulative preferred, that's
is irrelevant almost. Okay, I mean they're semi-mature soon, but maturity is not relevant. Usually, it's like you said, a lot of them are in perpetual maturity dates. They don't have maturity dates, so they're way out there, but they can be called. And so, like I say, if you've got a preferred that's trading for $29 a share, and it can be called in a year from now, you know that you're going to lose $3 in the next year, you know, $4 in the next year. So you have to pay attention to that. Whereas if you buy an ETF, you don't have to worry about that stuff.
Great, thank you.
Yeah.
Thank you. And then I know you talked about trade volumes for the preferred shares. Is it fairly easy to sell the shares?
If you buy high volume ones, yes. I mean, you can find preferreds that trade 100 shares a day. You don't want those, you know. I would say you get 15,000 shares a day, you're okay, but 40,000 shares is better. But I think if you got 15,000 trading volume, you can sell it anytime you want. It's not a problem. But I wouldn't go for low volume preferreds. And you can see the trading volume on Yahoo. Just look on Yahoo, put in a preferred ticker, and if you can figure it out, and then the Yahoo gives you the average trading volume.
And there's a question about, you know, currently I've noticed that short-term preferreds and to some extent CEFs are being hammered, is this an overreaction to the ensuing interest rate hikes?
Which ones are being hammered?
Short-term preferreds and CEFs.
CES or closed-end funds, yeah. I don't think preferred, well, they're trading lower than they were in December, generally. Because in December, you wouldn't have found any trading for under 25. Now you got some trading for 24.50, stuff like that. So they're trading a little bit cheaper now than they were, but I think my experience, preferreds move up and down with the market, but they generally go back up to their call price eventually, or that neighborhood. So I don't think you really have to worry. Preferreds are paying 5, 6, 7% dividend yields. Compare that to what you can get anyplace else. There's still pretty good deal, and I think they're appealing to people. And I'm not seeing preferreds dropping in price that much. I monitor them every day, of course, because that's my day job. But they're not like sinking down to 20 or 23 or anything like that. They're like a 24.75 maybe. So I would stick with them. I think preferreds are really, I'm a really preferred person,
And Harry, there's a question around, I guess, how preferreds are treated for tax purposes. Are these like the yield that you speak of? Is it interest, dividends? Are there any situations where you have to worry about K1s?
Just a minute, let me get that slide back on. Had the tax treatment. Just a second. So again, if they're qualified, if they're issued by a regular corporation like IBM, they're going to be 15 to 20% as the tax rate. If they're issued by a REIT or BDC, the ones I listed here, or they're characterized as baby bonds, which is the payment is classified as interest, not dividends, then it's going to be regular rates that apply. Does that answer the question, or was it different?
Yes, that does answer the question, but you don't know of anywhere people have to worry about K1s.
I'm sorry, say that again.
Are there any situations requiring K1s?
Yes, we do have K1. We have one preferred in our, I didn't put it in the list I gave you, but we do have one preferred that requires K1 forms. We try to avoid them, but sometimes we just can't resist the numbers. But I put in there when I give you the here, when you look up a preferred, if it does require K1 forms, we would say that right here. Some people don't care about K1 forms, so most people don't like it. K1 forms are just more complicated than regular tax forms. So we try with all our dividend stocks to avoid even master limited partnerships. We try to avoid the ones that issue K1 forms, which it's pretty easy to do now. But we do have one in our preferred portfolio that does issue K1s, and it does say so in the description, right here in the description.
And have you ever measured the beta of preferred stocks over the S&P 500? Are they highly correlated or really not?
Well, preferred stocks are a lot lower, a lot less volatility than the common issuer. And I don't think, say, preferreds, you just don't analyze preferred stocks. You analyze the issuer. And as long as the issuer is paying the dividends there's not a lot of analysis to do on the preferred. You know, you buy them, they almost always trade up to 27, 28, $29 a share. So you want to be careful what they're trading at, because when they get called, you're going to lose money if you're at 29 and they're called at 25. So that's what you have to watch in preferred, but I wouldn't get carried away analyzing preferred itself. The preferred just pays whatever dividend it says it's going to pay. And oh, here's one. This one says K1 tax forms. Okay. So you just, as long as they're paying the dividends, it just doesn't matter as long as the price doesn't get up too high. And if it does, you sell it and buy another one that's cheaper. So I wouldn't worry about analyzing stuff about preferreds like that beta and things like that. It just doesn't matter, you know. That's my opinion. Someone might argue with that.
Got it. And I forgot if we answered this question earlier, but in the current climate, where just about everyone knows that interest rates are going up, do we assume that it's just not the time to invest in preferreds? Should we wait?
I wouldn't wait, because you're not going to go down that much, and eventually they'll go back up. You know, if you look at preferreds that have been on, they're out there for 3 years, they're all turning for over $25 a share, you know, unless there's something wrong with the issuer, you know. And sometimes, Shamira, I think that's a mortgage REIT. Sometimes they trade lower because mortgage REITs are kind of always out of favor. And but basically, I just wouldn't. I forgot exactly what your question was, but I just don't think you should worry. You buy the preferreds for the dividends, and as long as you're sure they're going to pay the dividends that they're supposed to, just wouldn't worry about any preferred. Just make sure that you got them. You know, preferreds go up and down with the market. You know, when the market goes down, your preferreds will go down, but they won't go down as much, and eventually they'll go back up to their call price.
Got it, Harry. And so maybe you could talk a little bit about, you know, the, I guess, reason that people hold preferreds. Are preferred stocks usually held by institutions and higher net worth individuals? Do they do it mostly for that risk management that you talk about? And is the preferred market, you know, how big is the market in total?
Oh, I don't know. A lot of preferred stocks trade hundreds of thousands of shares a day, you know, so I don't know how big the market is. Now, you can see, I brought this back up because you can see back here in 2018, I don't remember exactly what was happening, but something happened that drove everything down. Preferreds went down in price. So then you look a year later, you see, where did that 24% come from? You know, it wasn't from their dividends. They all bounced back up the next year. So that's the way it goes. Preferreds will track the market, just not as bad, but eventually they'll recover. You know, that's basically the way it is. I just don't think you're not going to get, where else are you going to get 5, 6, 7% dividend yields? You're not going to get it from bonds, even if you buy bonds directly. You're not going to get it. You might get it. You're going to get it from BDCs, business development companies, and you're going to get it from mortgage REITs. Those are the two kinds of places you're going to get the yields that preferreds pay. But preferreds have way lower risk than BDCs and mortgage REITs, in my opinion. Maybe you got a different. I sound too enthusiastic about it. I should be more, you know, cool about this. Okay.
So have you found that high frequency algorithm traders also play in the preferred market?
No, they don't go there. We have a feature on Dividend Detective called Dividend Capture, where you buy a stock, collect the dividend, and then sell it. That's where the high frequency traders live. That's a whole different story. if you want to do that, we have an advanced dividend capture strategy that I recommend where you don't actually collect the dividend. You sell it the day before the next dividend date. But that's for a different topic.
Buying preferred stocks at the IPO price, are there situations that what happens if it's oversold?
I don't know. I really don't know. I'm not in that market because, like I said, I wait for 3 or 4 weeks to see what its trading volume is, because I can't recommend stocks that don't have high trading volumes. I mean, I won't. So I see the trading volume before I recommend them. So I don't know. I've never tried to buy them the day of issue or anything like that.
Got it. And do you have any opinions on PIMCO closed-ended funds like PDO or PDI? They seem to be on the defense lately, meaning that their market price is declining relative to the past year or so.
Well, our closed-end fund went down, took big hits in January. In fact, they went, it wasn't just their premium, their net asset values went down. I'm not sure because ETFs in the same field didn't seem to have the same problem. So I don't know what's going on with those right now. But I assume they just, their net asset values will rise when the market rises. Right now, as you know, we're in a very precarious time because we don't know what's going to happen with the war and, Russia and all that kind of stuff. And who knows what's going to happen in the next few weeks. So I think it's batten down the hatches time right now, actually.
Got it. If I bought a preferred at $25 plus, and it is currently trading below 25, should I be selling it and buying another one?
No, I would just hold them till you get close to the call date. Just collect the dividends and don't worry about it. You can buy another one that you find some more trading at 24, buy them, but I don't think trading, I've never done it. I just hold on to them. And these returns, these are the returns that we got, year to year. Like I say, you have a bad year, then you have a good year. So I don't think it matters. I don't trade them. I just don't think that's an easy thing to do. And again, I think if you buy a preferred when we add it to our portfolio, and if you sell it when we tell you to sell it, say you hold it 3, 4, 5 years, your average annual return will be about 8%. If for someone who wants to collect income, I think that's a pretty good thing. But if you're a person who wants a higher dividend yield or higher return than 8%, then it's not for you.
And then, Harry, we have a more general question. I know that you mentioned you look at free cash flow.
Yeah.
But can you maybe discuss a little bit about, the difference between free cash flow versus net profit and why you would focus on free cash flow instead?
So cash flow, operating cash flow, and operating cash flow is what they make from them, whatever their business is. Earnings per share is subject to all kinds of manipulation and doesn't reflect the actual profit. It's done with a lot of assumptions and things that are used to calculate earnings. Cash flow, operating cash flow, actually measures what went into a company's bank accounts as a result of their operations. That's real money. That's not manipulated. So that's the bottom line. And the EPS doesn't mean anything. It's cash flow. Operating cash flow is what they made. And then the subtracting the capital expenditures gives you the free cash flow. And so that is the money they have to pay regular dividends and to buy back shares, or what they want to do, raise their dividend. And I have found, and if you subscribe to Dividend Detective Premium, you could go to a place where you see all the stocks with positive free cash flow pay, say, more than 2.5% dividend yield. And if you track them, you find they beat the S&P 500 over time. Not every month, but over time. So to me, free cash flow is the bottom line. You know, EPS is just a manipulated number. And again, that's just me, I'm opinionated, but that's what I think.
Thank you. If, as an investor, we're not in need of cash flow, then should we be reinvesting our dividends back into preferred shares until, you know, we sell the position?
Yes, it's always good to reinvest the dividends unless you need money. You know, a lot of people that buy dividend stocks are older and they're looking for, they're worried about return and stuff like that. So you just keep reinvesting your dividends until you need the money. You know, that's it. You know, I think, and I keep saying 8%. 8% is a high number. From you try and get 8% from any other thing, you know. So it's significant. If you're in retirement, 8% is a good number to get. You know. So yes, reinvest the dividends to answer your question.
Got it. And then is the call date the date you watch for in order to sell?
If a stock can be called 6 months from now and it's trading for $27 a share, I know I'm going to lose $2 if it gets called. It won't necessarily get called, but even so, once you pass a call date, it usually trades between 25 and 26, say about 25.50. So you're going to lose money. So if it's trading at a premium to the call price and you're within 6 months of the call date, I think it's time to sell.
All right. Now, looking at ETFs and closed-ended funds, do you know if the dividends from those are taxed as qualified or non-qualified?
I think they're mostly qualified. I'm sort of guessing. No, it depends on the. It depends on the closed-end fund. I think it depends, but I'm not sure. Now you got my question. I forgot. Just a second. Let me look. I think they're mostly. Yeah, I think closed-end funds are mostly 15-20% dividends. That's my opinion right now, but I'm not an expert, so that's my guess.
Excellent. So it looks like we've covered most everyone's questions. If you saw that we skipped it somehow, feel free to type it in again here. And we'll just wait a couple minutes for questions.
Okay.
I have one question.
Oh, yes.
Yeah, so how much time is required, like if I'm investing in preferred stocks, because I have to keep watching for the call date and everything. So on an average, in a week, how much time do you spend?
Well, it's when you buy it, when you make the buy decision, as I said, you've got to really analyze the issuer. So that takes whatever time. If you do it the way I did, it takes you 5 minutes to look at the free cash flow on Yahoo. You know, you don't have to don green eye shades or anything. Just look at the free cash flow. That's what you need to do. Once you've bought the stock, then you have to look at the call date and pay attention when you get close to the call date. Otherwise, you don't have to do anything.
And what is how many stocks you should have in the portfolio? Like,
Well, you should usually have 5 at least, because you can make a mistake. So I would say get 5, and then you're pretty good shape.
okay, thank you.
We want to thank Harry for coming in today and giving us his update. I know earlier we shared support at dividenddetective.com where you could, email and get ETF information.
If you want to know, contact me at support@dividenddetective.com. I'll answer your questions. Want to know a good restaurant in Santa Cruz? I'll tell you where to go.
Now, if you go to our website today, you'll find slides, and then we'll share the recording in about a week or so.